Everybody, here's Adam. He is from WHEDA, super well versed in this. So thank you so much for attending our WHEDA webinar. And Adam Schnabel will take over here. And feel free to put some Q&As in the chat as we go through. Throw in your questions. We're happy to answer them along the way, or we'll take breaks. And we can also answer them at the end and go through any potential scenarios you have and go from there. So thank you again for attending. And here you go, Adam.
Thank you, Tom. Like Tom said, my name is Adam Schnabel. I am an account executive with WHEDA, so Wisconsin Housing and Economic Development Authority. I do have the chat up on my screen, so I can definitely monitor for any questions that come through. Otherwise, if you have the ability to unmute yourself, feel free to. I like free-flowing conversation. It leads to some great conversation and great questions. Just a little bit about myself. I'm born and raised Wisconsin. I reside up in north central Wisconsin with my family. And I've been in the industry for, this is, I think, my 16th year. Been origination, processing, capital markets, management. I've kind of been around the block when it comes to mortgage world. So feel free to just ask away any questions. You got a really big resource on the call through Tom and then myself through WHEDA. So now's the time you have our attention. But feel free, like I said, to stop anytime and ask those questions. As with anything in our industry, in the mortgage industry and real estate industry, things change. They're constantly changing and evolving. We always recommend that you go back to our website and view any of our current information. Obviously, things that I'm going to go through today aren't going to be out of date. Today, we're really going to hit some hot topics, a lot of the misconceptions and what a WHEDA borrower looks like, what we are, what we do, who we are, the benefits, and just some really general information when it comes to WHEDA. And then the programs that we have and the down payment assistance options, how they look for your borrowers and what they can be paired with. And then as well as how we work with lending partners like Tom. And then what WHEDA means for pre-approval, as well as how that looks for an offer for you. And then finally, any resources for yourself and your clients. So first here, really, clients, when you get them coming through the door, they're not going to come, through the door or calling with bright flashing lights saying, hey, I need a WHEDA loan and I need to speak to a WHEDA lender. I don't know really where to start. It's through investigating and listening and asking questions that we find out where we need to send clients to and who we need to send them to. So when you're having conversations, and this first one I always chuckle at because everyone would love a reduced rate. I mean, let's be real. Everyone would love a reduced rate in today's rate market. But when you're hearing things like reduced rate or down payment assistance or affordability or things like, I think my credit score is good enough or we have limited income. Those are all key topics that being discussed, you should get them over to a WHEDA lender as soon as possible. Now, the reason you need to get them to a WHEDA lender is because we offer things like reduced interest rate and down payment assistance and affordable payments because we have reduced mortgage insurance, or we don't we don't adjust the rate because of a credit score. And our products are geared towards low to moderate income borrowers that are residing in Wisconsin. Now, it's really important to note that essentially our products are conventional and FHA, and I say this up front because we're going to talk about it again. They're conventional and FHA with just some unique features. Now, there are, unfortunately, some common misconceptions when it comes to WHEDA, and I want to tackle them up front with you before we really get into the nuts and bolts of this presentation. And I want to clarify this because there's a lot of this floating around still, especially over the years. Now, WHEDA borrowers don't need to be first-time home buyers. We work a lot of times with borrowers that are downsizing their home or they're increasing the size of their home. or they, um, maybe on their third or fourth home in their, home journey. And that's perfectly fine. As long as they're fitting within the income limits and they're eligible for WHEDA, they're eligible to borrow with us. Now, they don't have to need down payment assistance. We have many borrowers that are, selling their home and using their proceeds as their down payment. Maybe they're getting a gift. Maybe they're really good savers and they've got 20% down or more. Um, we don't require that they have down payment assistance. A lot of times for borrowers that have that 20% down and they happen to be a first-time home buyer, it makes sense rate wise, if they're eligible for WHEDA, to get a WHEDA loan because they're saving over 1% on the interest rate getting that discounted rate. Now, a lot of times I hear that, well, WHEDA requires additional inspections or it's government financing. Well, it's not. We don't require additional inspections. We're not like the VA where we require a termite inspection or anything like that. We're going to follow what's in your offer. So if the client's buying a home with a, private well, private septic, and they are requesting it be inspected, in the offer, well, then we're going to follow that, but we're not going to request anything outside of it. And we're also not going to request a copy of the home inspection. Appraisals are going to follow the loan program. So this is a surprise to some realtors because sometimes they think that they're going to have a HUD appraisal regardless of what program they pick with WHEDA. And in fact, if you have a conventional loan with WHEDA, you're getting a conventional appraisal. If you have an FHA loan with WHEDA, you'll get a HUD appraisal. It's going to follow the program. There's no limit on assets, so your clients could literally have enough money to purchase the home in cash. If they're income eligible for WHEDA, they can still take advantage of a WHEDA loan. And the other one that I get a lot is that, well, I heard they run out of funds. Well, service is our own loans and we're self-funded. So we have this revolving bucket of funds that we're able to continue to lend out. We're actually set up really well. The last time we were unable to lend was actually in 2008 due to the housing crisis or mortgage crisis. So after that, they set it up differently, restructured, and now we're structured to continue lending. WHEDA also, I hear this a lot that it takes longer or the loans are difficult. Well, if you know what a conventional loan is, if you know what an FHA loan is, if you know where to get, resources, it's really not any different than any other conventional or FHA loan that you may have experienced on the real estate side. It's just that the lender's chosen WHEDA as the final servicer. Now, who we are is, well, we're WHEDA. WHEDA is the Wisconsin Housing and Economic Development Authority. We were an established organization that's been part or a quasi-state government agency since, about a little over 50 years ago. And it was developed in order to increase affordable housing financing options within Wisconsin. Now, every state has a housing finance authority or an HFA, and they all do different things. Minnesota does different things than Wisconsin does. We do different things than Michigan. And that's the same throughout every state. And how we differ is that we are really three departments that exist within WHEDA. We have single family, multifamily, and then our community and economic development. Now, our single families where I reside, I focus a lot on, like it is, single family purchases. Our multifamily and commercial side works a lot with developers and affordable housing units, large complexes. They do a lot of issuing of tax credits. Our community and economic development portion, they work a lot with municipalities as well as contractors and developers. They focus a lot on, like, when you see downtown renewals and small business. Now, our mission as a whole is to give everyone access to safe and affordable housing in Wisconsin. Now we offer, you heard me talk about it, we offer financing that features some key benefits. We're going to go over the benefits shortly. And our goal, though, is to really make home ownership affordable, because affordability isn't up to me for your client. It's not up to you as a realtor. It's not up to Tom as a lender. It's up to the client and individual. No one can tell them what is affordable, because they're the ones that are making that payment and doing their own budget. Now we offer, two first mortgage financing options. We also have down payment assistance. We even have renovation products that exist. We also have home improvement options, and I'm going to actually uh, give you some sneak peek information on some upcoming products that aren't actually included in this slide. We'll do that at the end. And then the other thing too is that we have income limits. They range from 80% to 140% AMI. So it's really vast, and it's really leans more towards the moderate income, so that more people are eligible for WHEDA. Now it varies by program, household size, and county, and we'll kind of touch on that a little bit later. But it really does include a lot of people in Wisconsin. And then finally, we are going to service all of our loans, like I mentioned before. So all the money that we lend stays right here in Wisconsin. We're receiving those payments right in Madison. And when your borrowers or clients call, they are going to talk to somebody right in our Madison office. Now, we all kind of naturally want to know what benefits are when we make decisions, and large decisions like, buying a home. It's the biggest purchase that we make in our life. Sometimes we buy multiple homes, and it's the biggest purchase, several times. And we always kind of want to know what the benefits are of the loan that we're getting or who we're working with. Sometimes we don't know if we're getting a good deal. So benefits to your borrower or client really start with the reduced interest rate. We have 3 reduced interest rate options that borrowers could take advantage of. And the first one is obviously first-time home buyer. A lot of people, they hear WHEDA, they're like first-time home buyer right away. But again, we're more than that. We also have, if the borrower is an eligible veteran, through our Valor program. Now, it's not a VA loan. It's still conventional financing. So they'll still have conventional underwriting and a conventional appraisal. It's just that they're an eligible veteran with an honorable discharge. So to thank them for their service, we offer them a discounted interest rate. Now, you're probably familiar with target areas that are federally or state designated. We also offer discounted interest rates for borrowers or purchasers that are buying a home in a federally or designated target area. Now, it could be a whole county. There are 15 whole counties in the state of Wisconsin, but it could also be within a municipality. So there are several whole county, municipalities throughout the state. I mean, Wausau, Madison, Milwaukee, Janesville, Beloit, Green Bay. They're kind of littered throughout. There are some on the west side as well that have parts of their municipality that are in a designated target area. So if they're purchasing in that designated target area, they'll get a reduced interest rate. They also have an expanded income limit, so it's easier to qualify for that rate. Now, borrowers are able to take advantage of our down payment assistance that we offer, but we also allow them to take advantage of other down payment assistance sources, including options like Down Payment Plus or DPP, pretty common among our financial institutions within the state of Wisconsin. But we also allow them to utilize like NeighborWorks or other organizations or nonprofits. Even municipalities that offer down payment assistance, we're allowing them to take advantage of. They don't have to take advantage of ours. Now, we also, because we're an HFA, have the access to offer a mortgage credit certificate. Now, a mortgage credit certificate to your borrower or your client is a huge benefit. It's actually a tax benefit. And the HFAs throughout the United States are the ones that are charged by the federal government to oversee this program for their state. Now it offers up to a $2,000 tax benefit where it can increase their tax return or reduce their tax liability every year for as long as they have that loan. And even if they refinance, they can re-add it on so they can continue to take advantage of that benefit. Now, the other benefit to the borrowers, they're able to work with local lenders right where they live. They don't have to work with somebody that's, outside of, their living or where they live outside the city or outside the state. They can choose to work with. We have over 150 lending partners, large mortgage companies, banks, credit unions, small brokerages. We have a ton. They're all throughout the state of Wisconsin. A lot of them can lend anywhere in the state of Wisconsin, like Tom, but some have designated regions, like credit unions may only be able to lend in certain areas. Now, we don't charge any what are called loan level pricing adjustments. This is a huge benefit to your borrowers. So really what that means to you is that your borrowers, whether they have a 640 credit score or a 780 credit score, those two individuals are going to get the same rate. Typically, the 640 credit score may pay a high or take a higher interest rate and have their rate adjusted because of their credit score. And then lastly, this benefit really plays into affordability is that we have the ability to offer reduced cost mortgage insurance. You all know that when you finance more than 80% of the value of the home, you have to pay MI. Now, we have the ability to offer that affordable mortgage insurance or charter level mortgage insurance. And really it is a significant decrease. If they have to take standard level coverage with a different loan product, they're paying a 35% coverage. With the affordable level or charter level, they pay an 18% coverage. So it's half. It can cut their mortgage insurance in half, which really plays into affordability. So a little bit of information when your borrowers are obtaining a WHEDA loan is that the home has to be located in Wisconsin. That's a given. They can't take advantage of the program if they're purchasing a home located in another state. It doesn't mean that they could be, moving to Wisconsin from another state. That's perfectly fine. It's just that they have to finance a home located in Wisconsin. Now, it has to be owner occupied for the life of the loan. Now, life of the loan is up to the borrower. It's however long they're going to live there. So that could be 2 years, it could be 30, really up to them. Now, they have to meet household income limits. Remember, we talked a little bit about that 80% to 140% AMI, depending on the loan program, county, and household size. Now, it's separate from qualifying income, and I'm not going to get too into the weeds about this, but they have to meet the household income limits in order to be eligible to utilize WHEDA's loan options. Now, they have to reside in the property, so it has to be owner occupied. We don't allow any non-occupant co-borrowers, co-signers, or guarantors. So anybody that's going to be on the loan has to live there. And then really important, if you are drafting an offer and they're getting a WHEDA loan, we see this a lot. And we added this in here because we get a lot of questions on it of, is it all right if, my boyfriend is on the offer or my girlfriend is on the offer? Only borrowers that are approved for the loan and any non-borrowing spouse are the ones that can appear on things like title, the offer to purchase, the note, and other mortgage documents. Girlfriends, boyfriends, shouldn't be on those documents. After we pass this through legal, this comes down to a bond thing for us when we're funding, using bond funds to fund the loan. We do require homebuyer education, so that is a given for your borrowers. It's only if they're first-time home buyers, though. So if they're a first-time home buyer, they'll have to take it. If they're not a first-time home buyer, it's waived. They're experienced. They've owned a home in the past. It's great. They know what they're doing. But if they're purchasing a multi-unit property, because you can purchase a multi-unit property, they have to take landlord education, which surprisingly, both homebuyer education and landlord education is free. It's just a matter of the time that they have to put into it, which is usually an hour for each of them. They have to possess a valid social security number and proof of legal residency. So we are able to finance utilizing certain visas. We can finance DACA status borrowers through our FHA product. So we can finance more than just the typical US citizen. So it's really a cool program that is able to, again, be used by just about anybody purchasing in the state of Wisconsin, as long as they meet our income limits. The only thing is they can't have an ITIN. They have to have a valid social security number and have that proof of legal residency. Now, I want to define household members for you, because household members, some reason, became a gray term. And this is just because we have to take into consideration anybody who's going to be living in the home. So a household member is anybody that's going to be occupying the property at the time of closing, regardless of relationship to the borrower or borrowers on the loan. So because we're in a time of multi-generational homes, we're seeing more and more where we've got 4 adult household members on a moving into a WHEDA financed home. Typically it's parents moving back in with their children because they need assistance. But when we look at household income limits, we have to take into consideration all income coming in from every household member. So just keep that in mind. And like I said, I just want to define that household member so that it's not so gray. Now, as for our mortgage products, like you heard me mention in the past, we have conventional, we have FHA. Now, for the conventional product, we're going to follow Fannie Mae guidelines. So if you're used to Fannie Mae, nothing's going to be different. It says 620 minimum credit score average. That's really meant towards our manual underwritten loans. Tom can probably confirm this. Most likely you're not seeing an approve eligible through our automated underwriting, with a 680 to a 700 credit score, or I mean through Fannie Mae's automated underwriting, not WHEDA's. 620 really plays into manually underwritten loans where individuals with lower credit scores can still obtain WHEDA financing. It just is looked at different. They have different qualifications to meet. Now, DTIs are going to be determined by AUS. I've got loans that I've seen now approved up to 49%. I've seen loans require 6 months reserves. I've seen loans require no reserves. So it's really what Fannie Mae's AUS is going to spit out as a response when lenders like Tom run this through their system. Now, we allow borrowers to purchase single-family homes, condos, 2 to 4 unit properties. This is new for some people. They didn't realize we can do multi-unit properties, but yes, borrowers can purchase up to a quadplex and become instant landlords. And we also are able to finance double-wide manufactured homes, provided they're on their own land. Now, when it comes to purchasing a multi-unit property, just a couple things. One, borrowers have to at least occupy 1 unit. 2, we do require 6 months reserves. That is a Fannie Mae requirement, so we require it. And you're going to get a standard conventional appraisal no matter what kind of property they're purchasing under a conventional loan. Now, our FHA product runs a little bit different. We have a conservative approach to FHA. Reason being is because we have a waiver with HUD. The waiver with HUD is what allows us to offer down payment assistance behind an FHA or a government backed loan. So your borrowers can take advantage of 100% financing on a government loan, which isn't typical. So we have that conservative approach because we want to maintain that waiver. So we do require a DTI, I guess, max DTI of 45%. It can be less. And we require a minimum credit score of 640, which FHA traditionally, as an originator, I originated loans at 53%. I originated, loans at 580. And we just have that different approach because we never want to lose that ability to offer DPA behind our FHA loans. Now we have two down payment assistance products. And the first one is probably the most popular. And that would be our easy close. Borrowers can get 6% of the purchase price to put towards their down payment, closing costs, or single premium MI. There's no additional inspections or separate loan approvals when obtaining our down payment assistance. So it's really underwritten all at the same time. Now, that 6%, typically 3% will go towards their down payment, and the other 3% will go towards the remainder of the costs. Sometimes borrowers are even able to refund or get back their earnest money, even costs of inspections if they paid it for any inspections up front, or even at their first year of homeowners insurance, if they paid that up front, they may be able to get that back. It is a loan. It's not a grant. Neither one of our products are grants. So they are paid back. The easy close is paid back over 10 years. And just, so you have an example of a payment, 11,400 at roughly, like when I did the calculation, the rate was 6.375. Over 10 years is roughly 126 bucks. So it's really affordable. It's no more than a high interest credit card. And what happens is this allows borrowers to retain more in their savings. As a lender, I was offering easy close to my WHEDA borrowers, whether they had 10 or 15,000 or more in their savings account. Because what happens in the first year of home ownership? Something is going to break, something's going to go wrong, there may be a leak in the roof that was missed, something happens. And if we as lenders take all their money that they had and put it towards their down payment and closing costs, how are they going to pay for these items? How are they going to finance a new furnace or an AC or fix a roof? They have to take out a personal loan if they aren't able to save for it. So an easy close allows them to keep money in their savings account and still have that safety net in case something goes wrong. Now, there are no prepayment penalties. So if after a year or two, they're like, we're good, they can pay it off in full. And that's perfectly fine with us. The loan did its job. It allowed them to be financially secure, save the funds that they had in their savings account, maybe able to even add more to that savings account and still have that safety net just in case something went wrong. Now, Capital Access is our other one. This is a $7,500 loan, flat loan amount. It can't change. And it's 0% interest. So it's still a loan. It's not a grant. It's just not paid until either the first mortgage is paid off or refinanced. Now, this pairs very well with other down payment assistance products that have a zero payment or zero interest, or even grants. So a lot of times, and I've seen Tom do this personally, borrowers get a WHEDA loan, they're getting Capital Access, 7,500, and then they're also getting 10,000 of down payment plus funds. And now the borrower has 17,500 going right into the transaction. And they're set up with only having one mortgage payment. Capital Access is a huge benefit. It's really geared towards those low income borrowers, just like DPP or Down Payment Plus is. They use the 60% AMI limit, and that's what we use for Capital Access. Now, we work with over 100, well, now it says 165. No, it's over 150 but over 165 financial institutions in Wisconsin. And like I said, they include banks, credit unions, mortgage companies of all sizes. Now, state statutes state that we're not allowed to directly lend to consumers. So we can't take loan applications and process the loan and do all that and give the loan, fund the loan just like Tom would be doing. We have to work through networks of lenders. So through these networks of lenders, potential buyers, borrowers are able to take advantage of the WHEDA products that we're able to fund. And we fund them by purchasing the loan post-closing from banks, credit unions, and mortgage companies. Now, lenders are able to have the ability to work through multiple lending channels with us. We have 3. And we have the broker channel, the mini correspondent channel, and our wholesale channel, which is our correspondent channel. Now, the correspondent channel, this is where Tom's institution exists. They do everything. They underwrite the loan. They're taking on all the risks. So underwriting turn times are up to the lender at that point. Mini correspondent and broker channel lenders. So these sometimes are a lot of times are our banks and credit unions or smaller brokerages. We're the underwriter. So it's our underwriting turnaround time. So like today, I think our underwriting turnaround times have finally decreased. I think we're back down to 4 days. We were at 7 just due to volume. But it's important to know as realtors who may be, and I hate to use it, but who's holding up the transaction when it comes to underwriting. It could be WHEDA, it could be the lender. We do allow lending partners to pick and choose WHEDA programs. So just because you work with Tom doesn't mean that, ABC Bank down the road might offer other programs or only offer conventional or only offer FHA. Every lender has the ability to choose those programs they want to offer that best fits their scenario. So that includes a lot of times our renovations or our renovation products or our home improvement products. And then we allow lenders to also put additional requirements on our program. So it's not often. I maybe see it 1 out of 25 lenders may put additional overlays on their WHEDA products, and it's only because they maybe have a conservative approach to it more so than we do. But it's really based on their risk tolerance. And the only time I would say that we see it is within that correspondent channel when they're the wholesale lender and they're taking on all the risk. Now, what WHEDA programs mean for your offer to purchase really starts with the pre-approvals that are issued. So the pre-approvals that are going to be coming from lenders like Tom, they can be issued by the lender or with WHEDA information, and it's based on their preference. So you may see on one WHEDA lender's pre-approval, it just says conventional. On another WHEDA pre-approval or from another WHEDA lender, you may see it says WHEDA conventional. It's really up to the preference of the lender. Now, if you see one that says WHEDA conventional on the pre-approval letter, it's really the same as a standard conventional financing pre-approval, really focusing on the word conventional. Same with FHA. It really is just a standard FHA financing pre-approval. Now, remember that those appraisal requirements are the same as industry standards. So don't let that, fool you when it comes to that pre-approval that there's going to be extra appraisals. It's going to be a conventional appraisal. If it's a conventional pre-approval, FHA, you'll have a HUD appraisal. Now, when it comes to down payment assistance, you may not know they're getting down payment assistance based on the pre-approval. A lot of times the lender may tell you, or a borrower may tell you that they're getting down payment assistance through organizations like NeighborWorks or the municipality that they're moving into. But if they're getting WHEDA down payment assistance, just know that it's underwritten the same time as the first mortgage, and there's no difference in timing for the approval and no extra inspection requirement. So when you're writing your offer and you're seeing this pre-approval, Whether it says WHEDA conventional or just conventional, we're not requiring that you put WHEDA conventional financing in the financing contingency. It's really up to your brokerage of what they're going to require. So if you're not sure, definitely reach out to your broker, or if you have a legal department that you refer questions to, really inquire about, do we have to put WHEDA? Do we not have to put WHEDA? From WHEDA's standpoint, we don't require it in the offer. We also don't require any DPA addendums. I know they have been filtering through, but we're not requiring it. You're actually following the LTV or loan to values that are on your pre-approval letter when you're filling out that financing contingency. Sometimes we've seen it added in the additional information section, or we've seen those addendums float through. But a lot of times we're seeing just the 97% financing, 3% down, and the down payment assistance is the icing on the top for the borrower. Just note that if they're getting any non-WHEDA DPA or down payment assistance through, like I said, NeighborWorks, it's the only one I can remember at this time, or the municipality, just so that they have separate program guidelines, so they may require a DPA addendum, or the DPA be listed in the offer in some sort of fashion. So just make sure you're checking with them when you're filling out your offer. So when you're coming to present the offer, it really, if you have a conventional WHEDA pre-approval letter, it's conventional financing. And if you're the agent presenting it to your seller, you can present it as conventional financing. It's really no different than any other conventional loan. It's just that the lender has selected WHEDA for this final servicer. Now, there are a ton of resources available to you as realtors, to consumers, for your clients. We have a whole consumers page, resource page that's devoted to budgeting and other resources. We have the list of approved lenders. Tom is listed on there. We also have first-time homebuyer information, as well as a live webinar for our first-time homebuyers. Realtors, we give you access to everything the lender has access to. So if you're clicking the WHEDA lender toolkit, that's everything Tom has access to. Everything you need to know about WHEDA is going to be there. Additional webinars that are pre-recorded if you want some additional information. There's a ton of information there for you, and I highly, highly recommend that you bookmark the lender toolkit, just in case you have that borrower that comes through and they have a question, or they're getting a WHEDA loan, or you want to print something out. It's available to you. Now, before we dig into questions, you heard me mention our home improvement options. We have, and I'm just going to highlight this. I don't even know if Tom knows about this yet. He may have already heard it through the grapevine. All of you know about the legislation that was signed last year by our governor. It was like $500 million that was put into affordable housing. We have a home rehab or home repair program that is coming out. There's two. One is a loan, and one, for the first time in a long time, is a forgivable grant. We have two options that borrowers may potentially be eligible for. This can be taken advantage of post-closing. It cannot be taken advantage of through closing. It could be, they've purchased the home 2 years ago and they now need a new roof and new windows. So keep that in mind. One is forgivable, one is a loan. The loan is a 30-year second mortgage at 3%, which is unheard of in the industry. And in fact, we will put it in the third lien position, no matter if we have the first or the second mortgage. So we're really wanting borrowers and homeowners to take advantage of these funds up to $50,000 to repair and rehab their home. I mean, mold remediation, asbestos remediation, roofs, windows, siding. This is really geared towards making the home safer. If it's a foundation thing that can be in there. I've had questions about falling decks, 2-story decks. Is that yes? Anything regarding health and safety can be taken advantage of as part of these programs. What we can't do is put like a pool in with it, or a spa or quartz countertops. Those are all sort of luxury items. This is really geared towards making that home livable and safer for the homeowners. So keep that in mind. It is coming, and it's going to be coming quick. But please, now you have Tom and I, two big resources. Myself on WHEDA, Tom on mortgage products and mortgage lending, and current insight into the mortgage market. Please, what questions do you have?
Feel free to take yourself off mute or put your question in chat. Adam, did you say that's 30 years, 3% rate?
Yeah,
Wow.
on the second or third, depending. Yeah.
Okay.
So I think if they get the whole 50,000, it's like $200 for 30 years.
That's significant.
Mhm.
So basically, that'd be a great scenario for somebody where the property doesn't necessarily need it. Maybe it's just dated, right? So then instead of doing the renovation product, this would be a good one to do afterwards, because better terms, better rate on that, and it's
Mhm.
separate. So I mean, to me, it makes more sense to have the client do that afterwards, right?
Yeah, it's a significant program, and I know they're putting a big amount into the bucket for this, and they're hoping that they can lend out all of these funds within a year.
Okay. And
So
then how long is that process? Like after closing, how long do they need to wait? And then how long would it take to get the money then?
So on that product, we're not doing an appraisal, we're doing an AVM. They have to, I'm not sure on how long they have to wait. That's a good question. I haven't really asked that.
Okay.
They have to have some sort of housing payment history. So I know like they're pulling, so this answered my own question. They have to have proof of 12 months of a housing payment. So whether that's a previous mortgage or some sort of rent, and it has to be on time.
Okay. Cool. All right. Perfect. One other question I'm sure that agents do have here is, with the NAR settlement, how does that have any impact to the financing for WHEDA, whether it's conventional or Valor or FHA, and what I mean, how can that be handled, or if the seller doesn't want to pay for it?
Um, so I apologize, Tom. I was reading a question that came through the same time that you
Oh,
started asking. So if you don't mind, I'm going to take the question from Holly
yeah,
first. So
yeah,
she has a client that's looking at selling her house, had a down payment assistance loan. She's asking, will she be responsible to pay the remainder back, or will the remainder be paid with the proceeds from the sale of the property when they close? So if she has a WHEDA down payment assistance loan, or she has even through municipalities typically are a loan, they're paid back when they sell the home, it's going to come out of the proceeds. So even if it's WHEDA, and I know with municipalities working with local HFAs, so yeah, you said pretty sure it's through WHEDA. Yes, it's going to get paid off through the transaction, come out of our proceeds. So it's going to show two mortgages against the property. So when the title company is putting together the numbers for the transaction, they're going to request a payoff on both the first and the second. So she'll have to pay that off through the proceeds so that the house is free and clear when they transfer ownership to the new owner. Great question, though. So Tom, can we go back to your question? Can you repeat that?
Adam?
Yes, I can hear you now.
All right, I got froze there
So,
for a second.
yep.
So it was regarding NAR and
Hmm.
commissions. So that's a big topic, right, for
Yeah.
our industry right now. Come next week with what if we have a seller that might not be willing to pay the buyer's side
Hmm.
compensation? How do you guys look at that? Whether it's conventional FHA, Valor program, is there any differences or not? Or
So our legal hasn't really come down with a clear and definite answer. However, after discussing, things with um my manager and even the director, from my manager discussing with the director, we have seen instances where buyers are paying their 3%. A lot of times it's in transactions where it's a for sale by owner, that the buyer has a realtor and that homeowner just is flat out not paying it. The buyers have to pay it. So we have seen it where it's included as a closing cost on the loan estimate. The biggest thing is it has to be disclosed on the loan estimate in order for it to be deemed a closing cost from our standpoint. But like I said, we haven't seen anything official come down from our legal department regarding NAR, and how that's going to look. But we have seen transactions come through in the past that I can speak of that um, oh, it sounds like it's going to be written as concessions in the offers. Okay.
and then I guess are they going to be putting that in an addendum A then, or would you put it on line or page 10? I guess I would ask the agents that are making the comments here for clarity on that. But that way I know where VA that they allow it as a seller concession, and assuming conventional hasn't really, from my understanding, they haven't made any changes yet that we're aware of, but that would count towards the 3 or 6% depending upon their down payment at this point.